Welcome back. President Biden is now calling on Congress to give regulators more authority to hold failed banks accountable, saying that banks and their executives should face stricter penalties for mismanagement or excessive risk-taking. Move comes exactly 1 week after the stunning collapse of Silicon Valley Bank, and it caps off a wild and volatile week for banks and Wall Street, despite yesterday's news that a group of 11 major banks had agreed to essentially rescue the ailing First Republic Bank, by depositing $30 billion into its accounts. Yesterday, Treasury Secretary Janet Yellen assured Congress that the U.S. banking system was sound. I'm joined now by Thomas Hoenig. He's the former president and CEO of the Federal Reserve Bank of Kansas City, former vice chair of the FDIC, and now a distinguished fellow with the Mercatus Center. Mr. Hoenig, let me start with the basic question here. Failure of the bank executives, failure of the regulators, both, and who's more at fault?
Well, certainly failure of the banker. It's their responsibility to run a bank, even when there is a lot of turmoil in the market, which there has been. So that's the first point of responsibility. Yes, failure, I think, at least it appears to be, on the supervisor. And I think it has more to do with the fact that this bank grew so rapidly, 6% a year for 3 years. That's a red flag. I think they'll have to look to see if the examiners and the Federal Reserve looked into that carefully. And then when you do that, you would see the concentration in the sources of funds, and you would then examine carefully their risk and liability asset management procedures. So they're on both parts, and it has to be looked at and corrected, I hope, going forward.
You know, it's interesting to me, all these bank failures that we've been seeing over the last couple of weeks, they did have one thing in common, not just medium-sized banks, but they all basically had sort of a single sector clientele, if you will, right? Or a single industry and all this stuff. Can you create a regulation to avoid that, or are you better off basically just raising capital requirements for banks like Silicon Valley Bank or the bank in New York? I think it was Signature. Yeah.
Well, I mean, one of the principles violated there was you're supposed to diversify your loan portfolio just like you do, like you and I would be expected to do. So I think there is that, and the examiners should be taking a look at that. But I also think one of the issues that we have in our banking system is it is a highly leveraged system.
Yep.
And I have said for some time that the capital, having the investors put more capital, more of their money at risk in the activities would, I think, bring a better degree of discipline to the management's action, since the people are right there, and their directors would be some of those who follow that bank management and say, hey, I got my money in this. Yeah. Let's take a little closer look at all this.
You know, it's funny you bring up something that is very popular with hedge funds, which is they'll have the capital, they'll use their capital to borrow money, use the borrowed money to do the investment, and keep their capital.
Right.
I mean, is that something that we should be preventing, banks shouldn't allow? What would you like to see change there?
That's the business of banking. However, I would say this. If you have capital, you might borrow money, but you're putting your capital to work just as much as you are the money, because if you don't put it to work, it doesn't earn anything for you, and you're not going to do very well. So their money is there working. It's just a matter of how much money you can borrow against that capital that will define how much risk you're taking on. Because the reason you do that, you leverage your bank, you borrow this money, is you get a higher return on your capital.
Right.
So you're going to take risk. And if you take too much, you're going to get in trouble. And that's what happens. So you have to have more of your own money at risk.
Right.
Yes.
The housing crisis, there were too many loans where people only had to put down a couple of percentage points down, right? Not enough on that. And that same thing. Let me talk about, you know, one of the phrases I remember during the financial crisis in 08-09 is, I know people want some Old Testament justice, but we just don't know where to do it. Meaning, hold some folks criminally accountable. Does somebody need to go to jail here? What would a law like that look like? And should bankers face jail time if they mismanage a bank?
That would be a pretty severe punishment, because people mismanage things and they get into trouble. I think there are criminal laws. If they embezzle, if they commit fraud, if they misreport their financial statements deliberately, they can be indicted. But failure, that's part of the capitalistic system. So, you make mistakes, you fail, that's the correction. One of the things about banking that makes that so hard is that when the bank fails, it has these broader implications like you saw last week with runs on bank. But that's, that's not a criminal offense. And I'd hate to make failure a criminal violation in any situation. That's just, I think, going to lead to really bad outcomes in terms of who you can get into banking, who's willing to take on that kind of risk.
Right.
Now, there should be clawback provisions. If they got bonuses, bring those back and didn't earn them. So those sorts of things are good, but you don't want to criminalize banking failure because unless there's fraud or misbehavior.
Right. What's the lesson you take away from the fact that the big banks, we kept those tighter regulations on them, had them have to meet certain capital requirements, and they were there to help be their own backstop here with these mid-sized banks. Should the mid-sized banks have the same? Should we now look back and say, no, they need to have the same rigorous capital requirements that the big banks do?
Well, actually, the regional banks actually hold more capital per dollar of asset than the biggest banks. When you compare it in terms of equity capital to assets, which is the measure, they're actually more heavily capitalized. They're just they're not as large. The big banks, the advantage the big banks have, let's just face it, they're too big to fail. Right. So they have that. That's a huge advantage in the business. Right,
but didn't we just learn that Silicon Valley Bank was too medium to fail? I mean, that's
well, we did.
Yeah. I mean,
and there's going to be a lot of debates about that because think about it for a moment. You have a $20 trillion industry, and you have a $300 billion bank fail, and suddenly that's systemic. No one thought that was the case.
Right.
However, remember this too. This bank, look, we're going through a shock. We've increased interest rates in this country by a factor of 20 in less than a year.
Right.
That is shocking the banking industry. This bank is not the only bank with billions of dollars of unrealized losses in their balance sheet. So we want to get through this, keep things calm, but I think that the rigor is there regardless, but you are going to have failures when you shock an economy, and that's what we saw.
Well, don't forget, we've been living through a shocked economy since the start of the pandemic, which we just marked the 3rd anniversary of essentially the global shutdown. Never easy to reboot an economy after you did what we did. Anyway.
And we went to zero.
Exactly.
You do all that, you get a system around it, and then you shock them up. So, it's a tough time.
It is. Thomas Hoenig, really appreciate you coming on and sharing your experience and expertise with us. Thank you.
Thanks for watching our YouTube channel. Follow today's top stories and breaking news by downloading the NBC News app.